Greetings. We are back with another monthly market commentary series. The madness of March was real. Not only did we have a basketball tournament, but all sorts of surprises in financial markets, from bank failures, interesting market action, a potential Fed pivot. So we're going to discuss a lot of these dynamics. And the question I really was curious about, what is the equity market performance post Fed pause? Meaning the Fed hikes, it's their last hike, they're transitioning into a pause. What is equity market performance after such instances? So we're going to look at empirical evidence and try to unpack the month of March. We're coming to you live from Pure headquarters in Lake Oswego, Oregon. So welcome to all of the clients across the 16 states in which we have clients. And if you're new to this, I hope this helps you filter out a lot of the noise that's going on right now and make better investment decisions. So this is Tuesday, March 28th. Most of you will be getting this either Thursday or Sunday in our newsletter. So let's get into it. I'm going to share my screen. So this chart is something that I alluded to. And one thing I noticed after Silicon Valley Bank went under, there was a lot of finger pointing going on. And I think it's important to zoom out because this wasn't a typical bank failure. If you missed my blog post about SVB, I would encourage you to go back and read that. This was a very specific and interesting case. But I think the broader symptom is what happened over the last 12 years, right? And when you think about it, interest rates were basically at historic lows for the better part of a decade. Poor investment decisions get made when interest rates are low. You have people reaching for yield and reaching for return and taking risk. You have a lot of money chasing not so good investment opportunities. And when the Fed does this, when the Fed hikes, increases interest rates from basically zero, so I'm looking at the red line, at the fastest pace in this data set, so since the early 1980s, most people think about inflation and rates going up, they think about the late 70s and early 80s. Look at the blue lines, which marks 1983 and 1984. Sure, rates are going up, but a much less aggressive pace compared to what happened in 2022, where this line basically went straight up. The takeaway is, when rates are low for over 10 years, poor investment decisions get made. When interest rates go up very quickly, something breaks. And what people talk about breaking, what people talk about as a risk, a recession, inflation, all of these things are seldom what derails markets. I've said this time and again. Everyone wants to know what happens next. Everyone's talking about risks that are lurking in the bushes. Okay, when the Fed hikes this aggressively, something breaks. It's impossible to understand what is going to break. I went back and read every Wall Street note or most Wall Street notes from the fall and winter of 2022. And nobody, I repeat, nobody had a banking crisis in the first quarter of 2023. So the best way I can classify true risk in practical investing, in real world investing, risk is everything that you haven't thought about. So everyone's talking about a recession. The very fact that everyone is talking about a recession makes a potential recession less intense, right? It's a known risk. True risk is everything that people are talking about, what's left over after that, if that makes sense. Okay, so this is the S&P over the last year. So this is as of last Friday's close all the way back to March of 2023. And to no one's surprise, this has been a wild ride. And there's a couple takeaways here, and I think this is very interesting. And I'm going to zoom in on this box, which marks essentially part of the fourth quarter of last year and much of the first quarter through last Friday's close. One, this has been impossible to market time. So people always want to understand what happens next. This has been a very difficult market. Again, nothing has made sense. If you're trying to jump in and out, you probably have egg on your face. But most importantly, over the last month or so, this banking crisis, this recession risk talk, the market has been very resilient, which is actually a bullish sign. So the news cycle current events, the banking crisis has given the market every reason to sell off, and it hasn't. I don't know if the worst is behind us, if bears are simply fatigued, if people are buying the dip, or people are optimistic, or the market is looking ahead. But given all the headlines, like if you were to not watch the market action over the last month and you could only read headlines, which is actually what a lot of people do for some reason, you would expect this chart of the S&P to be a lot worse. You would expect things in 2023 to be ugly. As of this recording, the S&P is up about 3% on the year. So it's hardly a disaster. And again, given all the headlines, this current market action is actually quite encouraging. What causes us to pause, and you've probably heard about this on the news, the volatility in the bond market is not normal. Okay, there's no other way to put it. And what the bond market is saying and what the Fed is saying is completely different. And we'll get into more on that later. But it's going to come in ahead. It potentially could cause some more disruption. Okay, so you can see this chart. This is the US 2-year Treasury yield over the last 12 months. The 2-year Treasury bond should closely or loosely follow Fed interest rate policy. And I think that shows up here, where as the Fed has increased rates in 2022, this 2-year yield has drifted higher. And that makes sense. The Fed can influence, through their interest rate policy, short-term bond yields. Okay. What is not normal is the cratering of the 2-year yield. Okay, the market is essentially saying we're not buying the Fed is going to continue raising rates. So this is a dramatic move. A lot of this was a flight to safety to protect against bank failure. So you saw a lot of investors, a lot of depositors taking money out of the banking system and investing it in high quality bonds. It doesn't get any greater quality than the US 2-year Treasury bond. But it's also signaling that despite what the Fed says, that they're going to prioritize inflation over these banking issues, investors voting with their capital are saying, we don't really buy it. Yields have plunged. This is a massive move. This is an outlier move for a traditionally safe and steady bond asset class. This is not normal. And I think market sentiment based on Fed futures backs that last chart up. Okay, so the market expectations are saying the Fed hiking cycle that lasted all of 2022 and part of 2023 is potentially over. And the market now is actually pricing in more than 1 quarter point cut by the July meeting. So all that means is the current Fed funds rate is going to be, based on market expectations, a little more than 0.25% lower. And get this, by January of 2024, it's saying the Fed funds rate potentially could be 1% lower. This is a dramatic shift from even a week or a few weeks ago. And if you reconcile this information, the market pricing in cuts versus what Chairman Powell said during his last press conference, they're speaking a different language. Now, I can understand what Chairman Powell is doing. He's trying to talk down the market. He's trying to talk tough on inflation, which does have some effect. The Fed uses their language. They use their forward guidance to convince markets or to manage market expectations. But sometimes the market will say, we don't buy what you're selling. And I've been pointing this out for some time now, that the market, the bond market, has not been buying what the Fed is selling. And it's very important to note, a lot of people look to the Fed as a leader of economic and monetary policy. And to some extent, that is true. But they're very much data dependent. They're very much at the mercy of market expectations. Historically, disruptions happen when market expectations and Fed speak or Fed policy diverge. And that's what's happening now. And I've been writing about this for years. When the Fed makes a pivot, either going from increasing rates to cutting rates or from cutting rates to increasing rates, historically, that's been marked by disruption and volatility. Eventually, these two things converge, and usually market expectations win. Okay, so we showed you 2-year yields. We showed you Fed funds expectations. This is the US 10-year bond, and this is the yield over the last year. Okay, so while the Fed has loose control over the short end of the yield curve, right? 1-year bonds, 2-year bonds, the Fed has much less control over longer maturity bonds. What drives this, what drives 10-year Treasury yields are growth and inflation expectations. So this is saying one of two things, maybe a combination of two things. It's saying growth is going to be less, lower growth, which is consistent with a lot of the economic data that's coming in. It's consistent with a lot of the recession calls that are coming in. Okay. This is also saying inflation is going to be lower. All right. So this is another puzzle piece that is consistent with all of these other market expectations, the Fed pausing, inflation subsiding, a slowdown in economic activity. A lot of people watch the equity markets for cues or to take the temperature on what the market is doing. I can tell you the smartest investors on the planet watch the bond market. The bond market sniffs out what's going to happen next before anything else. So this is very thought-provoking to us. This is part of our rules, and we use these inputs into our investment process. Okay, so this is really interesting. So let's say the Fed is going to pause. They're done with their hikes. How does that affect the equity markets? Okay, and we have 5 different instances over the last 30 or so years that can provide some context on the potential range of outcomes. Okay, so this shows S&P performance following the last hike of the cycle from 1994 to 2023. And you can see the various line colors in the corresponding years. What's interesting about this, and this is something that I very much like, is it shows the time leading up to the last hike of the cycle. The last hike of the cycle would be marked by 0 months. So the 12 months preceding the last hike and the 12 months following the last hike. And you can see in every instance, aside from 2006, the summer of 2006, when you think about that time period, we are on the doorstep of the financial crisis. But aside from that, following the last hike of the cycle, the equity markets were overwhelmingly positive. And you can see where we're currently at here in the red. It's kind of tracking some of this noisy movement. So back to my earlier point, when the Fed is upon a potential pivot like they are now, you can see the volatility in equity prices. Post the last hike in 2000, 2018, and 1995, the S&P was overwhelmingly positive by anywhere from almost 20 to over 30%. Now, I'm not saying that's going to happen this year, but we're fans of evidence, and this is a piece of evidence that is relevant. So let's drill down at the sector level. So same time period, same circumstance, except instead of the S&P 500, we are going to look at the S&P sector performance following the last hike of the cycle from 1994 to 2023. And we break it down by 1 month, 3 month, 6 month, and 1 year. Now, I don't care about 1 month and 3 month. That's a very minuscule time period when you're talking about investing. In this left column, you can see all the sectors. Now, you'll notice the real estate sector is missing. That's a relatively new sector, so we strip that out of the data set. But look at 6 months and look at 1 year. And the light green and the dark green are the best performing sectors. And then this percentage positive is simply that, the percentage of instances that are positive following the last hike of the cycle at the sector level. And some of the market action currently happening right now is validating some of this data set. So if you look at what's outperformed this year, it's big tech, which has been a surprise to us, right? We've long said that big tech probably had their day in the sun. If you think big tech is going to outperform in the future, you're basically betting that interest rates are going to go back down to zero, which might be an exaggeration, but that macro backdrop of low inflation, of low rates, really was a tailwind to tech. You sprinkle in a pandemic when we were all locked inside, it added a spark to Tinder, and basically the tech sector saw a huge ascension, which a lot of the air is coming out of that bubble. But for the high quality companies that make a lot of money, that have revenue, that have reduced their headcount, tech is certainly leading in 2023, which again is consistent with this data set as the best performing sector, or one of the best performing sectors, over the next 6 months and 1 year following the last hike of the cycle. So if you want to drill into any more of this, or I'm going too fast, you can just pause the video. You can look at this, you can go back, and you'll be able to digest this, because I know sometimes I move quickly. Okay, consistent with that last slide, one other thing that we watch is the semiconductor index. And this has been coined by some investors as the transports of the 21st century. And I'll explain what I mean by that. So back in the old economy days, right, when we were making stuff, shipping stuff, moving goods around, a lot of our economic activity and GDP was based upon us making stuff. We've slowly transitioned to a more technology, digital, service-based economy, which basically means we're making less stuff. So in the old economy days, people used to track rail activity, logistics activity like FedEx and UPS, air freight prices, ship freight prices. They used to track the cost of moving goods across the country. It was called the transport index, the transportation index. That could give someone insight on the level of economic activity. As that index moved up, that potentially meant good economic times. As that index moved down or slowed, that could potentially be a slowdown in economic activity. The modern day digital economy transports, coined by some, is the semiconductor index. And that makes sense. Think about, and these are just chips that go into everything that we use, from cell phones to cars to computers to cameras. The activity and the performance relative to the broader market is closely tracked by some investors. Despite the banking crisis, despite calls for a recession, a slowdown in economic activity, this semiconductor index, the transports of the 21st century, has not validated those opinions. This is very strong relative to the broader market. Let's dig a little bit deeper into the transports relative to the S&P 500. Okay, so what we're tracking now, again, is consistent with that last slide. We're looking at the relative performance of semiconductors, which has gone up, versus the performance of the S&P. Okay, and we're tracking performance 1 month, 3 months, 6 months, and 1 year later. And again, we don't care about 1 and 3 months. That can be extremely noisy. So can 6 months and 1 year, but it's a little bigger data set. And we're basically tracking relative strength versus the S&P. So when the semiconductor index is really high versus the S&P, that would mean high relative strength for the semiconductor space. Okay, so we're tracking what that means going forward for the S&P 500. When semiconductors are showing high relative strength over the next 6 months and 1 year, the average and median performance for the S&P 500 is about 11 to 16 or 17%. Okay, so strong semiconductor performance relative to the S&P 500 is a good thing for future stock performance over the next 6 months and 1 year. And again, this is that same data set from the mid-90s as of last Friday's close, so 2023. Switching gears So, of course, the Fed is watching inflation. They're talking tough on inflation. I showed you the market's not buying it. If inflation continues to subside, that could potentially give the Fed ammo and a reason to pause and potentially cut. So all of these trends, all these inflation trends, whether you're tracking the CPI, you're stripping out food and energy, if you're tracking what producers are paying for commodities and materials to make goods, these are all moving in the right direction. Sure, there could be fits and starts, and this might spike back up, but these are all moving in the right direction, potentially giving the Fed ammo to pause. And I've touched on this in the past, but this whole inflation narrative, it certainly was a thing. So I'm not doubting that. But consumers change their behavior. They change their expectations. They don't keep spending money the same way if inflation is a problem. And that's starting to show up in the numbers. That's shown up in the numbers. And I think this really puts a bow on that, where inflation expectations in some of the most popular surveys are going down. Consumers are expecting inflation to go down. And all this noise about a recession and the banking issues, all of these things add to how consumers and investors make decisions. Okay, so I think too often in finance, too often in investing, we spot a trend and maybe it's a negative trend and we extrapolate that out over the next 3, 4, 5 years. That's not how things work. That's how human minds work, but that's not how economic data and investing work. People tend to overweight what just happened and they extrapolate that out over time. And that happens in good market environments, in bad market environments. In 2021 or in 2019, it'd be hard pressed to find an investor that wasn't all in on the S&P 500, right? The S&P just went on a great run. Many people were looking to shovel as much money into US large cap and tech stocks. And what happened? The cycle turned. So you can't set your watch to any of this. What's true today could be completely wrong tomorrow. And I think the inflation information that I just shared, these expectations are a reflection of consumers changing their behavior and expectations. Okay, so let's wrap up with S&P intraday performance when Powell speaks. And I didn't pull the slide, but I'm pretty sure that Chairman Powell has the worst post-meeting performance for stocks out of any Fed chairman. And all that means is when he starts talking, the market goes down. So what this is, it shows all Powell Fed days since 2018. So when he took office, that's the dark blue line. And what happened last Wednesday, I believe, when he started talking. And you can see the white backdrop is before he starts talking. The dark gray, or the light gray, I should say, is when he starts talking. And in both instances, markets tank. And I don't know if he's being defiant. I don't know if he's purposefully trying to talk down the markets. I've heard he does not like when he speaks and the market goes up. He takes that as a cue that the market is not interpreting what he's saying. So I think he might go out of his way to talk really tough on inflation, to talk really tough on the future path of interest rates going up. Hence this ugly downward movement as soon as he opens his mouth. So this doesn't really fit in with my other comments, but I just think it's interesting. So we'll track this going forward. But the long and the short of it, I wanted to show you performance after the Fed's last hike. I think that's relevant to what's going on. What some of the internal market cues are saying. Most importantly, the bond market is not buying what the Fed is selling. In addition, the internal market performance by sector and by semiconductor aren't buying the recession narrative. And my last comment, which I think is very important to end on, is risk is everything that people aren't talking about. So when everyone's talking about a recession, that inherently makes it less risky because it's a known quantity. What is lurking is unintended consequences from rates being low for 10 years. Again, many people made very poor investment decisions during that period. And this won't be the last surprise that we get. I'm reminded of an old banker saying that the worst loans are made during the best times. And I think that's true. And it's consistent with what we've said all along, that the seeds of destruction are often sown during good times. So I'll leave you with that. Thanks for watching. Thanks for listening. If you have any questions about how we manage money, about how we work with clients, about how we think about financial markets, shoot us a note at insight@pureportfolios.com. Thank you.